In the world of finance, mistakes don't always stem from reckless decisions. Sometimes, a single moment of carelessness or an emotional lapse is enough to destroy decades of hard-earned wealth. Assets aren't stolen by the market or competitors. They are eroded from within by complacency, greed, and fear. Without emotional control, without building a margin of safety, without pausing to reflect, you become your own worst enemy. The journey to sustainable wealth begins not with chasing opportunities, but with mastering yourself. Those who endure are not the boldest, but the most disciplined, patient, and self-aware at every step of their financial journey. Now, let's reveal the brutal truths where only the disciplined survive to protect what they've built. Understanding the fragility of wealth. Wealth is not lost due to ignorance, but because of complacency. After years of saving, investing, and building, a single emotional decision can unravel everything. Mistakes don't arrive with loud warnings. They begin quietly, through seemingly harmless actions or brief lapses in judgment. In finance, complacency is the silent assassin. Past success provides no guarantee of future security if vigilance is abandoned. Every achievement requires continuous protection. One careless move, driven by unchecked emotions, is often enough to topple what took decades to build. Financial success demands a relentless commitment to awareness, not just to skill or strategy. A wrong decision often doesn't come with flashing alarms. It hides behind thoughts like, "This time is different," or "I already know what I'm doing." Individuals who have spent decades building their assets can lose it all because of a single emotional misstep. Such missteps often involve reallocating safe investments into riskier ventures without proper evaluation. The thirst for faster gains and the urge to catch up with the crowd often silence logic. In truth, the road to financial collapse usually begins not with foolishness, but with subtle emotional betrayals masked as reasonable choices. Protecting wealth requires understanding that the most dangerous mistakes are often the least obvious. They sneak in through decisions that seem normal or justified at the time. Every financial move, no matter how small, links directly to future outcomes. A single broken link can trigger a catastrophic collapse. Thus, maintaining financial vigilance is harder and more critical than building wealth itself. True financial mastery lies not only in making smart choices, but in sustaining disciplined awareness through every market cycle, every tempting shortcut, and every emotional impulse that threatens long-term success. The price of overconfidence. Confidence is essential for success, but overconfidence is a silent killer. After achieving a certain level of financial victory, many believe they are immune to failure. Vigilance fades. Caution that once ensured survival is replaced by impulsive decision-making. Decisions that once demanded careful scrutiny are now made hastily. When confidence turns into arrogance, individuals expose themselves to risks they would have avoided in the past. It's not intelligence but discipline that separates sustainable success from downfall. Overconfidence blinds even the smartest minds, making them vulnerable exactly when they believe they are invincible. Overconfidence cripples risk assessment. People convince themselves that past success means future immunity. They ignore warning signs, dismiss negative feedback, and believe experience alone shields them from loss. Just one misjudged step made under the influence of arrogance can trigger massive destruction. The higher the climb, the harder the fall. True survivors in finance are not those who feel invincible, but those who consistently respect risk, even at the height of success. Understanding that no one is above making mistakes is a superpower that protects fortunes more effectively than any strategy. The key to enduring financial success is not eliminating confidence, but governing it strictly. The wisest individuals maintain a healthy fear even during peak victories. Success must be met with humility and a clear recognition of personal limits. Remaining skeptical of one's infallibility is what keeps judgment sharp. Every financial decision, no matter how promising, should undergo rigorous scrutiny. The greatest financial victories come not from adding more wins, but from avoiding devastating losses caused by unchecked pride. The real challenge is maintaining the cautious mindset that fueled initial success while navigating the temptations of triumph. The paradox of success and risk. Financial success does not reduce risk, it amplifies it. When assets, reputation, and prestige accumulate, every mistake carries greater consequences. Success brings pressure to maintain momentum and outperform previous achievements. That pressure pushes individuals toward taking higher risks than necessary. Ironically, those who were once cautious are the most likely to fall prey to overconfidence after a winning streak. In finance, the real danger is not during the climb, but after reaching the summit. Without constant vigilance, success plants the very seeds of future collapse. The human brain reacts to success by releasing dopamine, encouraging the pursuit of even bigger victories. Like gamblers who can't stop after a winning streak, investors too often chase larger and riskier returns without realizing it. Long-term success does not automatically make one wiser unless each achievement is met with deeper caution. Each win should reinforce discipline, not erode it. Recognizing and resisting the addictive pull of success is essential. Staying grounded after triumph is what separates enduring wealth from fleeting fortune. Financial survival demands that success sharpens prudence, not dulls it. The greatest paradox of wealth is that the more you achieve, the more you risk forgetting the fundamentals. Every victory chips away at initial caution. Prolonged success breeds a dangerous sense of invincibility. Sustaining a healthy skepticism, maintaining meticulous risk evaluation, and treating each new decision with the seriousness of a beginner. These are the shields against downfall. Success should not be a free pass to recklessness, but a call to greater responsibility. True financial mastery lies in seeing success not as a finish line, but as a beginning of even tougher discipline. The emotional traps of financial decisions. Personal finance is not merely a numbers game. It is primarily a psychological battle. When facing market volatility, emotions like fear and greed often override logic. Investors panic sell during downturns and chase after rising assets during booms, abandoning rational strategies. The worst financial decisions are rarely made out of ignorance, but out of emotional reactions. Emotional discipline is the true differentiator. Mastering personal finance requires more than knowledge. It demands the ability to stay calm, think long-term, and act rationally when everyone else is reacting impulsively. Our survival instincts, designed for immediate threats, betray us in modern financial markets. In ancient environments, quick reactions to danger saved lives. Today, those same impulses drive investors to sell at the worst times and buy into bubbles. Fear magnifies losses, and euphoria blinds judgment. Recognizing these evolutionary flaws is essential. Without understanding how your brain sabotages your financial reasoning, you remain vulnerable. True financial strength comes from mastering these primal instincts, creating systems that enforce logic over emotion, and refusing to let short-term noise derail long-term vision. Winning in finance demands more than spotting opportunities. It demands emotional resilience. Building automatic habits, like pausing before making big decisions, sticking to preset investment plans, and setting unemotional triggers, is key. Training yourself to respond slowly and analytically, instead of emotionally, turns chaos into opportunity. Emotional mastery isn't about becoming robotic. It's about consistently choosing strategy over reaction. Those who can recognize emotional impulses and neutralize them swiftly will survive and thrive in any market environment. Financial success favors the emotionally disciplined, not the emotionally driven. Leverage, the double-edged sword. Leverage is a powerful tool, but it carries enormous risk. In favorable conditions, leverage accelerates gains, but when markets turn, it magnifies losses at terrifying speed. A small drop in asset value can trigger a devastating chain reaction when leverage is involved. Building wealth on excessive borrowed money creates a fragile foundation. Leverage rewards the lucky, but destroys the unprepared. It is not the presence of leverage that is dangerous, but the false sense of security it gives. Managing leverage responsibly is a survival skill, not a luxury. In the high-stakes world of finance, the appeal of leverage lies in controlling large assets with small capital. Yet few realize that leverage amplifies both reward and risk equally. When markets move against leveraged positions, losses escalate faster than logic can respond. Leverage is a game only for those who have built massive safety nets behind their risks. Without strong buffers, leverage turns into a trapdoor beneath your feet. It's not enough to chase bigger returns. True financial security comes from structuring investments so that one misstep doesn't destroy everything. Leverage demands humility, foresight, and respect for the unexpected. The secret to surviving leverage is assuming that things will go wrong. Never stake everything on a single bet. Always reserve enough capital to absorb unexpected shocks. Never believe you can perfectly control outcomes. When risks are underestimated, leverage mutates from a tool into a ticking bomb. Financial survival depends less on boldness and more on cautious preparation. The wise know that the market doesn't reward bravery without backup plans. Building wealth safely with leverage is about respecting its dangers as much as its potential. In finance, lasting success belongs to those who prepare for every outcome. Common mistakes in wealth building. You don't need millions to make devastating financial mistakes. Ordinary people who have spent years slowly accumulating savings can lose everything with a single emotional decision. Mistakes don't arise from lack of knowledge, but from letting emotions overpower rational thinking at critical moments. One rushed investment, one impulse driven by a fear of missing out, or one belief in a sure win opportunity is enough to undo decades of hard work. Wealth is not destroyed by ignorance alone, it's eroded by abandoning discipline when emotions run high. True financial success demands mastery over fleeting impulses. The temptation of get-rich-quick opportunities exerts a powerful pull. Seeing others flaunt quick profits triggers social comparison and the urge to imitate. Instead of patiently following a solid strategy, many abandon their long-term plans for short-term thrills. This emotional deviation from principle opens the door to failure. Financial markets don't reward speed or impulsiveness. They reward resilience and patience. In the end, survival belongs to those who remain anchored to their core principles while chaos whirls around them. Succumbing to the excitement of the moment often proves costlier than any market downturn. The biggest mistake in wealth building isn't picking the wrong stock, the wrong property, or the wrong industry. The biggest mistake is breaking long-term habits because of short-term emotions. When you trade steady, proven progress for the illusion of faster gains, you enter a dangerous game. Wealth grows through patience and discipline, not through chasing hype. True financial success is a marathon, not a sprint. Those who endure are not necessarily the smartest, but the most consistent and emotionally disciplined. Protecting your wealth means protecting your mindset against the seductive mirage of shortcuts. Financial psychology. When the brain betrays the wallet, the human brain is designed for survival, not wealth creation. In primitive environments, rapid reactions to danger meant staying alive. But in today's financial markets, those instincts sabotage us. When investments fall, the brain screams to flee. When others make quick profits, it urges us to chase. These survival instincts, once crucial, now lead to devastating financial mistakes. Without awareness, you remain at the mercy of outdated programming. Understanding this evolutionary mismatch is essential. Winning financially isn't about being fearless, but about overcoming ancient impulses and forcing rationality into the decision-making process, even when every instinct protests. Emotional responses prioritize short-term safety and reward over long-term strategy. Fear of loss triggers panic selling, while greed drives reckless buying. The pain of loss outweighs the joy of gain, leading to defensive behaviors at precisely the wrong times. Recognizing these deeply rooted biases is the first step toward mastering them. Only by anticipating emotional traps can you design systems that enforce discipline when it matters most. Successful investing requires battling not just external market forces, but the internal battle within your own mind. Mastery over wealth is mastery over primal instincts that no longer serve you. Real financial skill is the ability to manage yourself under pressure. It's not about spotting more opportunities, but about resisting self-destructive impulses. Each market downturn is a test. Will you react emotionally or respond strategically? Building habits like delaying decisions, sticking to pre-planned actions, and questioning emotional urges protects you. Emotional mastery is not about eliminating feelings, but about recognizing them and refusing to let them dictate your actions. Those who remain calm, rational, and systematic during turbulence will not only survive, they will thrive. Long-term wealth belongs to those who win the battle within. Mastering emotional control, the ultimate weapon. Emotional control is the ultimate differentiator between lasting success and inevitable failure. Financial markets constantly stimulate fear, greed, and impatience. Without iron discipline, people fall into predictable traps. Buying high, selling low, chasing trends. True champions don't react impulsively. They follow predefined strategies, regardless of market noise. Success doesn't favor the quickest, but the calmest. Building emotional muscle, the ability to slow down, reflect, and act only according to plan, is more valuable than any technical knowledge. When chaos erupts, those who can maintain internal order will emerge stronger. Emotional mastery is the real competitive edge. The secret to emotional control lies in creating unbreakable principles before emotions arise. Set clear risk limits. Predefine action plans for volatile markets. Commit to never deviating from your system based on feelings. When emotions spike, these preset structures serve as guardrails. Sticking to the plan is hardest when it matters most, yet that's when discipline pays off. Emotional resilience doesn't eliminate fear or temptation. It simply refuses to surrender to them. Victory belongs to those who act on logic, not adrenaline. In finance, as in life, structure beats chaos every time. Mastering emotions doesn't mean becoming emotionless. It means identifying emotional reactions as they arise and deliberately choosing not to let them drive your behavior. When fear, greed, or excitement surface, pause. Review your plan. Ask critical questions. Emotions are information, not instructions. Those who respect emotions but remain governed by principles build resilience few can match. Over time, emotional discipline compounds into massive financial advantage. In a world where most people are ruled by feelings, mastering yourself is the ultimate investment. True financial success is emotional success first. Building a margin of safety, the art of financial survival. A margin of safety is not just an investing principle, it is a survival philosophy. It means leaving a large enough buffer between expectations and reality. Never assume everything will go right. Always plan for worst-case scenarios. If things turn out well, it's a bonus. If they go wrong, you still survive. Those who build wealth sustainably don't bet on perfection. They bet on resilience. Success isn't measured by how much you make during good times, but by how well you protect yourself when everything goes wrong. Safety margins are what keep financial dreams alive through storms. The wealthy don't succeed because they never make mistakes. They succeed because they prepare for mistakes. They diversify portfolios, hold cash reserves, and never bet the farm. They assume that errors are inevitable and design systems that can absorb them. Taking calculated risks is essential, but reckless exposure is suicide. In finance, resilience beats brilliance every time. Building a margin of safety isn't about pessimism, it's about respecting reality. You don't control markets or luck, but you do control how much damage a mistake can cause. The more margins you build, the longer and stronger you survive. Margin of safety thinking extends beyond investments. It applies to debt, lifestyle choices, business ventures, and every financial commitment. If a single failure can wipe you out, the risk is too high. Always ask, if this fails completely, can I recover? If the answer is no, reduce your exposure or walk away. The goal isn't to eliminate all risk. That's impossible. The goal is to ensure no single event can destroy you. Those who thrive long-term aren't necessarily luckier, they're better prepared. Building wealth is about building safety nets at every stage of the journey. Financial checklists and the power of reflection. Before every major financial decision, create a personal checklist. First, ask, am I acting out of emotion or strategy? If fear, excitement, or pressure is driving the choice, stop. Second, can I accept the worst-case scenario? If a loss would erase years of progress, reconsider. A financial checklist isn't a formality. It's a defense against your future self's worst impulses. It forces deliberate thinking in moments when emotions scream for action. Financial success doesn't come from making perfect decisions, but from consistently avoiding catastrophic ones. Systems protect you when your emotions are too loud to ignore. Another crucial checklist item: have I slept on it? If a decision feels too urgent to delay, it's usually a trap. Immediate action under pressure often leads to regret. Giving yourself even 24 hours to reflect introduces critical distance between stimulus and response. Markets and opportunities move fast, but not so fast that thoughtful evaluation can't be part of the process. Rushing is the enemy of sound decision-making. Patience is the ally of wisdom. Those who pause and reflect consistently outperform those who react impulsively. Time reveals risks that excitement tries to hide. Finally, always ask, is this moving me closer to freedom or further away? Every financial choice either strengthens your future or weakens it. Reflection anchors you to your true goals. Investing without reflection is gambling with your future. Building wealth is not about relentless action, it's about intentional action. Success belongs to those who protect progress as fiercely as they pursue growth. Intentionality is the antidote to regret. In a world addicted to speed and shortcuts, deliberate reflection becomes a superpower. Protect your future self by acting today with discipline, caution, and clarity. Building wealth is hard, but protecting it is even harder. Mistakes don't arise from ignorance. They emerge from complacency, emotional impulsiveness, and overconfidence. Every financial decision demands vigilance, emotional control, and strict adherence to sound principles. No opportunity is worth risking everything you've built. Enduring wealth belongs to those who respect risk, build margins of safety, and pause to reflect before acting. Financial markets don't forgive carelessness, but generously reward discipline and foresight. In finance, victory doesn't belong to the fastest or boldest, but to the ones who endure, patiently, thoughtfully, and with unwavering commitment to their future.